Imagine it's December 1st, 2001. You're a 44-year-old civil engineer in Buenos Aires. Your name is Roberto. You have a daughter in university, a mortgage with 11 years remaining, and a savings account at Banco Nación containing $23,400. This is the result of 19 years of careful, disciplined saving. You don't consider yourself wealthy. You consider yourself responsible. Last Tuesday, your financial advisor told you everything was fine. Last Thursday, the economy minister appeared on television. He said the banking system was stable. This morning, you drove past your bank on the way to work and noticed something. A line, not a long line, just 8 or 9 people standing outside before the doors opened. You didn't stop. You had a meeting. By noon, the line was 40 people. By 3 p.m., the government announced the corralito. Every bank account in Argentina was frozen. You could withdraw a maximum of 250 pesos per week. The exchange rate, pegged to the US dollar for a decade, would be abandoned within weeks. Your $23,400 would become worth approximately $7,000 in purchasing power before the crisis stabilized. You didn't make a mistake. You didn't gamble. You saved. And the 8 people standing outside the bank that morning understood something you didn't. They had seen the signs. This is not a story about Argentina. This is a story about the 3 days that exist before every currency collapse. 3 days that look completely ordinary to most people and completely unreadable to those who know what to look for. Once you understand what happens in those 3 days, you will never look at financial news the same way again. Before we examine the pattern, we need to understand something that most financial education gets completely wrong. People imagine a currency collapse as a sudden event, a single dramatic moment, a government announcement, a market crash. Black Tuesday, the day the peso died, the moment everything changed. This is not how collapses work. This is the cinematic version, the one that makes sense in a 2-hour film. The actual mechanism is different. Every currency collapse in recorded history, Weimar Germany, Yugoslavia, Zimbabwe, Argentina, Venezuela, Lebanon, followed the same structure. A long period of gradual deterioration, largely invisible to ordinary citizens, followed by a very short window. In this window, the deterioration became impossible to conceal, followed by an overnight administrative event that restructured everything. The long deterioration is years, sometimes decades. The impossible to conceal window is weeks, sometimes days. The overnight event is hours. Most people experience the overnight event as a shock. The people who understood the pattern experienced the window. And inside that window, specifically in the final 3 days before the administrative event, there are always the same signals, not predictions, not speculation. Documented, repeatable, mechanical signals that have appeared before every major currency event. Let's examine them one at a time, not as theory, but as autopsy. Signal 1, the Q. It begins quietly, not at every bank, at specific banks, usually smaller regional institutions or branches in less affluent neighborhoods, where depositors are more sensitive to risk and less reassured by official communications. In Weimar Germany in November 1923, photographs show lines forming outside savings banks in Berlin's working-class districts, while the commercial banks in the financial center appeared normal. In Greece, in 2015, ATM queues in Athens extended around blocks. Not in every neighborhood. In specific neighborhoods where word had spread, where people had made quiet phone calls. In Cyprus, in 2013, branch managers at Laiki Bank reported unusual withdrawal volumes. The pattern is always the same. The queue begins at the periphery and moves toward the center. By the time it reaches the center, by the time it appears on television, by the time the government makes its announcement, the window is closed. The people who recognized the queue at the periphery as a signal, rather than a coincidence, had 2 or 3 days. The people who waited for official confirmation had hours, and often those hours were during a weekend when nothing could be done. Signal 2, the official reassurance. The signal is paradoxical, which is why most people miss it. In the days before every currency event, governments don't go silent. They become loudly, insistently, almost desperately reassuring. The economy minister appears on television. The central bank governor gives a press conference. Official statements emphasize stability, strength, the soundness of the banking system. In Argentina, the economy minister, Domingo Cavallo, appeared on national television on November 30th, 2001, the day before the corralito, and stated that the banking system was stable and deposits were safe. In Iceland in 2008, the government issued reassurances about the banking system's strength the week before all 3 major banks collapsed. In Venezuela, officials denied hyperinflation was occurring, while monthly inflation exceeded 100%. The mechanism behind this signal is not conspiracy. It is institutional logic. A government that publicly admits its currency is collapsing accelerates the collapse. Bank runs are self-fulfilling prophecies. If the government says there will be bank runs, there will be bank runs. So governments cannot say what they know. They must say the opposite of what they know, with maximum conviction, for as long as possible. This means that official reassurance is itself a warning. Not because governments are lying in a simple moral sense, because the logic of the situation makes Reassurance the only available public statement, regardless of what private assessments show. A government that is genuinely calm doesn't need to tell you to be calm. A government that is telling you to be calm is managing a situation that requires management. Signal 3, the policy acceleration. In the final days before a currency event, governments make unusual policy decisions. Decisions that seem unrelated to each other, decisions that are announced with bureaucratic justifications that don't quite explain the urgency, decisions that, in retrospect, were clearly attempts to build walls around the coming storm before it became visible. In Argentina, in the weeks before the Corralito, the government imposed limits on cash withdrawals from ATMs that were described as anti-money laundering measures. In Greece, Parliament passed emergency legislation about bank resolution procedures that received minimal coverage. In Cyprus, new regulations about interbank transfers were quietly implemented, days before the bail-in. These policy accelerations share a common characteristic. They are structural, not cosmetic. They are not speeches or statements or reassurances. They are changes to the actual plumbing of the financial system. The pipes are being redirected, and when governments start quietly redirecting financial plumbing without clear public explanation, something is being prepared. This is the most technical of the three signals and the hardest to detect without specialized knowledge. But the pattern is consistent enough that financial historians can identify these policy accelerations in the records of virtually every major currency event, always concentrated in the final 3 to 10 days before the visible crisis. Now step back and look at what these three signals have in common. The cue, the reassurance, the policy acceleration. None of them are on the front page. None of them are announced. None of them, individually, constitute proof of anything. You could observe all three and be wrong. History contains examples of cues that resolved, reassurances that were accurate, policy changes that were genuinely routine. The signal is not any single one of these. The signal is the convergence, when all three appear simultaneously. When lines form at peripheral branches, while officials insist everything is fine while new financial regulations are quietly implemented. The historical record is clear about what comes next. The pattern has repeated across 12 documented major currency events since 1919. Weimar Germany, the Soviet collapse, Yugoslavia, Mexico in 1994, Southeast Asia in 1997, Russia in 1998, Argentina in 2001, Iceland in 2008, Cyprus in 2013, Greece in 2015, Venezuela starting in 2016, Lebanon in 2019. In every case, the three signals appeared. In every case, the window was 3 to 7 days. In every case, the people who acted during the window fared dramatically better than those who waited for official confirmation. Now here is the uncomfortable question this pattern raises, not about Argentina or Cyprus or Lebanon, about now, about your country, about the system you're currently inside. The signals are not ancient history, they are documented and observable, and the conditions that produce them are not unique to developing economies or poorly managed states. Weimar Germany was the most culturally sophisticated nation in Europe. Iceland had one of the highest standards of living in the world. Cyprus was a member of the European Union. Greece was integrated into the most advanced monetary union in human history. Lebanon was called the Switzerland of the Middle East. None of it mattered. The math broke, and the signals appeared, and the window opened and closed. The United States federal debt currently exceeds $36 trillion. Interest payments now surpass $1 trillion annually, exceeding the defense budget for the first time in American history. The Federal Reserve's balance sheet expanded from $900 billion in 2008 to nearly $9 trillion at its peak. These are not political statements. They are published government figures. The Congressional Budget Office projects debt to GDP exceeding 150% by 2050, under current law. The last time a major Western economy sustained debt at those levels without restructuring was never. This is not a prediction. This is arithmetic. What this analysis is saying is simpler and more specific. The three signals are learnable. The window is recognizable. And the difference between Roberto standing in line outside a locked bank and Roberto's neighbor, who quietly moved 3 months earlier, is not intelligence, not wealth, not political connection. It is pattern recognition. The neighbor understood that official reassurance is a data point, not a reassurance, that cues at the periphery mean something before they mean something on television. That policy changes, without clear explanation, are signals, not bureaucracy. Roberto understood these things too, afterward. Afterward is the only time most people understand them, because the system they live inside has no incentive to teach them. The bank has no incentive to explain that your deposit is an unsecured loan to a private institution. The government has no incentive to explain that currency stability is a political choice, not a mathematical guarantee. The financial advisor has no incentive to explain that the products generating his commission are the first assets destroyed in a currency reset. The incentive structure points in one direction. Reassurance. Always reassurance. Until the corralito, until the bail-in, until the queue reaches your branch and the sign on the door reads closed until further notice. Roberto is standing outside that door right now, somewhere in the world. He is always standing outside that door somewhere. The 3 days existed. The signals were there. He just didn't know what he was looking at. This channel exists to change that. Not to predict when or where, to show you what to look for before you need to look for it. The pattern is already in motion somewhere right now. It always is. This is historical and educational analysis. It is not financial advice. Every individual situation is different, and what follows from understanding these patterns is your decision entirely. But understanding them, that part is available to anyone willing to study the record. Most people won't. Most people will wait for the official announcement. If you're still watching, you're probably not most people. You know what to do.